Hey guys, good afternoon. It's Vinod here from GrowWealth. Welcome today. It's Sunday, the 24th April 2022. Hope you're all well. Market isn't. Be prepared, brace yourself for potential market crash. That's the headline for the next week and what seems to be like the next few weeks, maybe months or so on. It is not looking good at all. As usual, let's look at our watch list and then go and analyze the stock market and the individual stocks that we've been watching. So the watch list performance, as you can see here, is not bad at all compared to how the S&P 500 has done since the initiation of this particular watch list. As you can see, the S&P 500 has returned around negative 4.8%, and 9 of our watch list stocks are outperforming the overall S&P 500 market. Although that's a really good position to be in, relatively speaking, but as you can see, a lot of them are in still negative return territory, although less negative than the overall market. The likes of Steel Dynamics, STLD, LPLA, and Shell, the London stock, are all the ones that are in the positive. The rest are all negatives, albeit a little bit less negative than the overall market is. There are 5 double-digit negatives, which is the underperforming stocks in our watch list. They are SWAVE, GFI, and NOX. I will in a second go to the individual stock charts to discuss about how they are performing. But the take-home message, I'll give it to you at the very beginning, is all bets are off from the table at this point. The market, because of its really weak close last Friday, and as a result, the whole of the last week, it's very likely to retest the previous low and also break down below that, looking at the character sentiment of the market action. So it is not wise to be swimming against the tide. I don't generally short the market. Most of my members don't. So stay cautious. If you're trading, be on very selective stocks that is actually performing well with a good chart setup at this point. If they're not, it's best not to be trading. Stay in cash. Cash is a position, and protect your mental as well as the financial capital. So let me now go to the stock charts. All right. So as usual, let's start with the CPC, the put call ratio index. On the weekly close, as per this CPC ratio, it closed at 1.3. Anything about 1.1, according to me, is indicative of bearish sentiment in the market. So quite a lot of people are bearish. This index is a contrarian indicator. So the more bearish, meaning higher than 1.1 price point in this chart, indicates a lot of people are leaning in one direction, which, this being a contrarian indicator, could mean that could be a short term, at least a short term bounce in the market. The reverse would be true if everyone is leaning bullish, which would look like a value of less than 0.8 in this chart, where interim top or short term top might happen in the stock market. So as per this contrarian indicator, we could have a short-term bounce in the stock market. However, I'm not too convinced about this, looking at the broader picture. But this is what the CPC is saying at this point now. The reason why I started this video with a very bearish tone and with a caution is because of what you're looking in front of you right now, the chart pattern of the S&P 500 on the weekly. There are 3 consecutive weeks of negative return, and it closed well below all the key moving averages. So downtrending 21-week moving average, 8-week moving average, and closed below the 50-week moving average. This index is officially now on stage 4 of stage analysis by Stan Winston. Looking at the daily, it's below the downtrending 8, 21, and 50 EMA. Moving on QQQ, this is the ETF following the NASDAQ 100 index. And this looks even more weak than the S&P 500. As you can see here, this has this previous resistance acted as support, and that support was broken here. It tried to reclaim, and it did reclaim for a couple of weeks, but then the last 3 consecutive weeks of high volume selling and that the NASDAQ had seen. As you can see, every week the close was towards the bottom of the trading range, which signifies quite a lot of selling is happening because it's on the high volume. It means institutions are bailing out of NASDAQ 100 type stocks. The tech stock has been in bear market for nearly a year now, but the index, which is primarily kind of heavily weighted towards the mega cap stocks like FANG names, are also breaking down at the moment, which is reflected now in the overall index breaking down. You may have heard about the Netflix earnings result, and the stock kind of gapped down 35% the very next day. Facebook has been in the downtrend quite a lot already. Apple is one of the last remaining FANG names that's holding a little bit, but also closed quite bearishly last week. Amazon and Google, Microsoft are all feeling the pressure and have a negative looking chart at this point. So coming back to the NASDAQ, so this broke down below this support, tried to reclaim, but this seems to be a false breakout now. And if this breaks down further, which it looks like it would do, the next target could be somewhere here at $300 mark for the QQQ index. And if that breaks down, then the pre-COVID top of around 237 or 236 level might be in the cards. So no one has crystal ball. I can't predict the future, but the market action is quite weak. So it looks like the previous low here in February 2022 is likely to be retested and perhaps might break down to this level. So caution is warranted. New York's Composite Index, similar to the S&P 500 and the NASDAQ, closed below the key moving averages on the weekly, and the 21-week moving average is starting to turn downwards. So it's not just breaking below that, closing below that indicator, but also the indicator is actually moving downwards, which is even more a bearish signal. The same story is everywhere in the indices. So Dow Jones Index, similarly, this was showing some resistance because there were blue chip stocks and defensive names on the Dow Jones Index, but that is also cracking at this point, which is shown in the form of a failed breakout here and finishing below the 50-week moving average on the Dow Jones Index. Russell 2000 has been weak for over a year now. It broke down below this support level back in January of this year, and then it tries to kind of build a base, try to break out of that previous resistance, but then it failed there. So then it closed below this kind of short-term upward trending trend line. So it looks like it's the base and break pattern, similar to the previous stock chart. So it's the next logical kind of support level would be around this point, around 167 mark, which would be the pre-COVID top, and also there's a gap here, so it may come to this point to retest that and fill that gap. So all in all, very bearish looking indices all across the board. Bitcoin is not doing much better either. It is still lurking below the key moving averages. It is in the stage 4 as well. On the daily, it's kind of lurking here around 38,000, 39,000 mark. It tries to push above 42,000 level, but then found 50 EMA on the daily as resistance and quickly pushed it down, and is now struggling to reclaim even the 8-day moving average, which is a bearish signal. So since we had the stop loss trigger based on the dual MACD strategy, we are out of this in our portfolio, VIP portfolio. and we don't have any entry signal yet on Bitcoin or Ethereum either. Moving on with our watch list names. So as I mentioned, all bets are off. I will cover this watch list, but this watch list won't be active for the next week because they are all having, almost all of them have a broken down chart pattern. It makes no sense to continue to monitor these watch lists for the next couple of weeks. GFI, I'll take this one off. So it had this kind of high tide flag. It broke out, as you can see on the daily, by gap up, which is a very strong signal you can ever find. Gap up above the kind of flag pattern on high volume, but the very next day it pushed downwards within that kind of flag pattern, and then even further to close the week well below the 8-week moving average on high volume. So this kind of high tide flag, the cup breakout, have all been nullified, and this is a false breakout. The next one is the ETF that tracks the FTSE 100 stock index of UK. So this is about the key moving averages on the weekly, and if you move to the daily, it doesn't look as bad as the US indices because this does have quite a lot of dividend paying oil and gas sector. But even the last remaining sectors that's been performing well, which are all the defensive names, that like the medical names, the oil and gas, the fertilizers names, have also started to pull back quite badly towards the end of last week. And that would reflect here by a gap down open on Friday, and then finished below the 21-day moving average, which it hasn't done for over a month now. So on the weekly, though, it's still about the key moving averages, but caution is warranted because, as you can see here, pre-COVID top at this point of around 32, 34, yeah, 32, 34 level is acting as a resistance. If the whole market cracks and the floor opens and falls off the cliff, then it's very likely that the FTSE 100 stocks may also find the pressure and can go down. But right now, it is not totally damaged, but not the strongest to consider the overall market action. AMR had a good ascending triangle breakout on high volume the week before last. However, similar to the most names that we are going to see, it had a false breakout in the form of the breakout failing quite quickly and two strong high volume closes to the downside on Thursday and Friday to close within this kind of ascending triangle, which means this pattern is now invalid, and it closed below the 8 and 21-day moving average on high volume, which means the entry has been a false one. So if you're in this stock, it doesn't look too strong to stay in the stock. I was on it and I closed off I exited the stock when it was showing some weakness here. But right now it is quite weak, and I wouldn't be surprised if further weakness comes in through this name. This is one of the last remaining sectors that were showing strength. So it's a bit concerning if these sectors is also kind of cracking, which doesn't bode well for the broader market. DE, it's still about this kind of year-long breakout, but as you can see here, it's an bearish engulfing candle close below the T line on the weekly with high volume. So it is bearish, albeit about the breakout level. So as you can see on the daily, 3 consecutive negative days, increasing range of the price action and increasing volume. And on the daily, it closed just beneath the 50-day moving average as well. So not a good one. It's bearish on this one. STLD, although it was positive return around 7%, I believe, for our watch list since its initiation. But as you can see, last week it had a shooting star type pattern, which means on the daily it is starting to crack and have a bearish sell-off actions. So on the high volume sell-off the last couple of days after the earnings result. So about the key moving average, about the resistant breakout level, which are positive, but this candle, along with the market action being weaker, doesn't look very optimistic. So if you are in this and have some profit, it's reasonable to consider partial profits, booking some profits, or at least adjusting your stop loss quite tightly so that you protect your capital. NTR, it almost gave a bearish engulfing. It didn't by 15 cents or so, but very bearish candle on higher than average volume and higher than previous week's volume. And on the daily, 2 consecutive negative days, very poor close towards the end of the trading range on Friday, on higher volumes the last couple of days, and closed below the T line, which it hasn't done for a couple of months. So there's a clear change in trend for this stock. Although on the weekly, it looks about the key moving averages. On the daily, there seems to be an early sign of change of trend to the downside. Shell, oil and gas sector, there is a resistance here. It came and traded within the resistance zone for the last couple of weeks. And last week, it gave a shooting star indecisive doji candle on higher volume. And it gapped down open on Friday. And I think it just closed right at the point of T line on the Friday, but on low volume. The positive action is on lower volume, negative action is on higher volume, which means there are sellers kind of building up on this name, and it could pull back a little bit or maybe crash like this week we had in February. So because of the resistance, poor action, and the broader market, I have exited this name with some profit. It could go up further because Shell is in a good shape. Oil and gas is still doing reasonably well compared to the other tech names. But looking at the overall situation, I don't feel as confident to stay on this name as a trading candidate. It's a great candidate for dividend reinvesting, but I'm looking at more position trading type setup. CVX, Chevron, another oil and gas sector. Again, I was looking for this kind of flag breakout, but then it broke down close below the T line on higher than previous week's volume. So another negative signal. Similar story for CAH. We had multi-month, couple of years actually, breakout here the week before last. It tries to follow through, but then pushed down by the weight of the market to close below that breakout level. Still above the moving averages on the weekly, and on the daily though, it gapped down and closed below the T line on not above average, but decent high volume. So still negative, not as negative as some of the other names, but not a great positive setup either. WPM, the gold did pull back last week. Along with it, WPM pulled back around 6.2%, close just around the T line, I believe. So where was it? Just above the T line on the weekly, but on higher volume. So gold is the one sector that I expect to perhaps weather. If the market crashes, then the gold might get some love and some investments. But then the stock needs to prove it to me, and the chart needs to be clearly bullish. Otherwise, I'm not just going to put my money blindly behind any gold names. It has to be in the uptrend. So I'll be watching this name and some of the other gold names. So it did gap down, but 50-day moving average is acting as a support for WPM. And this might, so that signifies a relative strength compared to the other price actions that we have seen so far. Next one is SWAV, doji, bearish candle, close below the 21-week moving average on higher than average volume and lower high. So not very positive at all. On the daily, negative close towards the end of the price action for that day and below the 50-day moving average. Higher volumes accumulating, quite bearish. LPLA, so it had a strong breakout the week before last on very high volume for 2 consecutive weeks. So ever since it broke out, let me make it a bit bigger for you. Ever since it broke out, it didn't retest immediately. It just kept going by at quite a speed. And then 2 days of high volume selling just brought it back to that breakout level. So this shows the change in sentiment. Buyers have given way to the sellers now. And if this continues, it will be a failed breakout. And it looks like a failed breakout at this point as well. It's not totally confirmed yet, but it looks like one if this price action continues and if the market weakness continues, which it looks like it would. So caution warranted on this name. And Knox, high volume 2 weeks, went to this previous support and turned resistance level. I was expecting it to kind of base and then resume its uptrend, but then the market weakness resumed, which led to this further breaking down close below the 8-week moving average. So it is continuing to be on the downtrend. So that concludes our watch list names. So that is the essence of what is happening in the market. Market crash, possibly going to happen. I don't think it will be short and sharp and recover like the post-COVID crash. It's very likely that it would be prolonged, dragging downtrend action. Who knows? This is my suspicion. Growth stocks has already taken quite a lot of it. Many of the growth stocks, like in the form of UPST, Shopify, SE, Cloudflare, NET, Coinbase, all of them are down by quite a lot of percentages, about 60%, 70, 80%, some of them. No one expected that this would happen in such a short time, but the overall indices is just starting to crack now. So we don't know how these price actions for those already beaten down growth stocks will perform when the indices, if the indices goes lower further. Nevertheless, the take-home message is stay cautious. Cash is a position. Look at the gold sector, gold and silver. There might be some safe bets there, but then be selective and don't rush a trade. If you are trading, swing trading or position trading, the environment currently is not conducive. So protect your capital, both mentally and physical, both financial and emotional capital. If you're a long-term investor, this may provide some good opportunity to gradually ease in. Don't put all eggs in one basket immediately. Gradually ease in to good companies that you have full conviction in over a long period of time, like months and years, perhaps decades to come. Hope it was useful for you. Stay cautious though. Happy learning and successful investing. Bye-bye. I see you in our next week's video. All the best.